these truths to be self-evident.
That all men are created equal.
As a member of Congress, I get to have a lot of really interesting people in the office, experts on what they're talking about.
This is the podcast
for insights into the issues.
China, bioterrorism, Medicare for all, in-depth discussions.
Breaking it down into simple terms. We hold
these truths. We hold these truths.
With Dan Crenshaw.
The Eagle has landed.
All right,
Nice
nice to meet you. Thanks for doing this. I know it was kind of last minute. We just wanted to get some expertise on SVB, and I won't take much of your time, right? I just want to get down and dirty on this, and don't have too much time anyway. So, I think we would want to get the basics out for people, help them understand what happened, what didn't happen, et cetera. Help me understand, frankly. So this will be very authentic because I'm trying to figure this out myself.
Yeah. So SVB is a tech funding bank. It's been around a long time. I think it's been around 40 years. It's actually owned by SVB Capital. It has a holding company. And one of the problems with SVB or the issue that caused it a problem was a couple things. It had invested in a lot of treasury securities and agency mortgage-backed securities, which back in the days when the interest rates were low, and it held on to them in its held to maturity portfolio. And it was funded with deposits that weren't insured. A huge percentage of its deposit base was over $250,000, which is the FDIC insurance limit. And
no, why is that? Is that because it's usually these startups, these businesses or wealthier individuals that are banking with them? Why is that not normal?
It's mostly business accounts. So if you have any kind of business of any size and you have to meet payroll and you have to meet expenses, $250,000 isn't a whole lot of money if you've got any kind of sizable operation. So business deposits, commercial type deposits of businesses are typically larger, but they didn't have a retail deposit base. So a well-diversified bank will have a lot of little depositors well under the 250,000 limit and some business customers who would have bigger accounts. It's not typical that a bank has a huge percentage of its deposits that are over the insurance limit. And because deposits that are over the insurance limit, they run. If there's any kind of panic or any kind of worry that the bank could get into trouble, those that are watching pull their money very quickly. And if you have a lot of big depositors and they move their money fast, it doesn't take long before you're having a liquidity crisis. And then it depends on the collateral you have and what you can pledge with the home loan bank and the Federal Reserve to turn securities that are illiquid into cash to pay your depositors that are withdrawing.
So is this some kind of perfect storm? And is there anyone to blame in particular, or is it mismanagement on multiple levels? Is it the regulator's fault? Is it Silicon Valley run amok? Because it's Silicon Valley Bank, and so I think some people just attribute it to Silicon Valley specific companies. I'm not sure people realize that there's small businesses from all over the country that bank with them. So who's to blame here, or if there's anyone to blame?
Where's the failure? Okay, the bank management should never have had a maturity mismatch like it had. Hedge funds, we typically think of funding relatively longer maturity assets that have a higher yield with short maturity paper that pays a little. It's kind of like a carry trade, right? So banks aren't supposed to operate that way. They're supposed to have a balanced plan and a liquidity plan where they can meet withdrawals. This bank didn't. Its securities, the ones that it would pledge for collateral, were underwater. They paid a very low rate of interest, and now interest rates are much higher. So they're losing money on those. Okay, so what's the big deal there? So they had a whole lot of securities in what's known as a held to maturity portfolio. And there's two ways you can hold your securities on a bank balance sheet. There's available for sale and held to maturity. If they're in the available for sale account, then every quarter when you put out your regulatory reports, you have to mark them to market. So if interest rates go up and you have a security that has a fixed interest rate, it loses value. In your available for sale account, you have to take a loss. if it's in your mark to market, if it's in your held to maturity account, you hold it at the price you paid for it, amortized cost. And so if interest rates go up, you lose money on those securities if you were to sell them, but you don't have to recognize that on your balance sheet. They had a lot of securities like that were held that are really underwater, and they were marked at historical values, amortized cost. When their financial statements came public in February 21, their December 31st call report statements come out. Investors can see that they've got a whole bunch of securities on their balance sheets. They're underwater. Okay, that's not a good sign. If you actually mark those securities to market, the bank would have less capital than it's reporting, and then people start to get worried. So they had a bunch of stuff that on their books under completely acceptable accounting, the way they're accounting, look like they're worth more than they actually would be if you sold them.
Okay.
And it's not just if you sell them. If you go and pledge them at a home loan bank or the Federal Reserve Bank, they're not going to give you before Monday. They're not going to give you the par value, the price you paid for them. They're gonna lend it to you based on a haircut from the market value of the security. So you don't have enough collateral to go out and recover the value of the loan. Now what regulators did on Sunday night was they established a new special Federal Reserve lending facility where banks will be able to pledge their underwater Treasury and agency-backed securities with the Fed and borrow the full par value, the full face value of securities that actually aren't worth that. The Treasury used its exchange stabilization fund to basically tell the Fed it would absorb the first 25 billion of losses if the Fed were to take any losses on these things. And these loans are good for a year. So the Fed has set up a program and there's a number of banks in the system that purchased, agency mortgage-backed securities, treasuries over the past few years because they wanted to get some yield on their securities and they're underwater now because the Fed's been raising rates. And so the Fed has now and the Treasury have now created a system where they can liquefy those securities if they need to at the par value, even though the market value of those securities is actually less than par. So there's some risk the Fed could take a loss.
I want to do our best here to try and speak about this in a language that most people can understand.
Okay, I'm sorry.
No, don't apologize. I want to get the technical version out for those who do understand it, but I also want to try and bring this down to a level we can understand. So, okay. I mean, banking 101. Okay, yeah. So people deposit money into the bank. The bank also does loans, right? So they're using people's money to dish out those loans. So there's some kind of
okay, let's start back a couple years ago.
Yeah.
There was a big influx of money into Silicon Valley Bank. People say the money came from the SPAC issuance that happened a few years ago in the COVID crisis. There's not these special purpose acquisition companies that were formed, which sold a bunch of stock, SEC registered, investors put a bunch of money into them. And the whole idea behind these firms is they didn't really own anything, but if you gave them money, they were going to go out and acquire firms, primarily tech firms. And that you would get in at the bottom, you would give this SPAC money, and it was essentially a fund that was going to go out and acquire tech firms.
Okay, so that's what made Silicon Valley Bank different from other banks.
A lot of that money went into Silicon Valley Bank. Okay, so their deposits grew like crazy since about 2020. I mean, they more than doubled. Okay, gigantic. Okay, now if a bank takes in deposits, it's got to do something with those deposits to make money. Deposits, if you hold just deposits in a bank, it's not free. They have to pay FDIC insurance premiums on the deposits. They have to service the deposit accounts. If they don't do anything that makes money with those deposits, they lose money.
Right. They're paying you. I mean, if you put money into a bank and you're getting some kind of return from your savings account.
For the longest time, interest rates were zero and you didn't get much of anything. Okay. Before last March, a year ago, March. So they get all these deposits. Okay. They have to do something with them to make money. So one thing they do is they loan out money. Another thing they do is they buy securities, okay, that they think they can liquidate if they need to. Okay. They bought what the banking rules consider very safe securities. They bought mortgage-backed securities insured by the government housing agencies, Freddie Mac, Fannie Mae, Ginnie Mae,
Right.
So they have all these things that have a government guarantee. Okay. So they're not going to lose money if the mortgages default. They're covered by the government. However, those mortgages have a fixed interest rate.
Mm-hmm.
And when interest rates go up, the interest rate on those mortgages in the mortgage-backed security you own don't go up.
Exactly.
So the mortgage-backed security bond falls in value. Okay.
Right.
The other, but mortgage-backed security bonds guaranteed by the government agencies have a very low capital requirement because they're guaranteed by the government.
Okay.
Okay. The other thing they bought with treasury notes and bonds. Okay. You could buy short-term treasury paper, but it didn't pay anything. So if you got these deposits, you want to earn some yield. So what they did was they bought longer-term treasuries that actually paid some interest.
Mm-hmm.
And what happened in the meantime? Well, interest rates went up, and when interest rates go up, the market value of those treasury securities, even though they're government securities, they're not going to default, but the market value falls.
Right. Right.
So they owned a whole bunch of these securities in their held to maturity portfolio. That meant they didn't have to take any of the losses through to their income statements or their equity capital. They could carry them at their amortized cost or purchase price, basically, even though if they tried to sell them, they would lose money.
Okay.
So if people come into the bank and they want their deposits back, well, look, you can't call in the loans, or you could try to call in loans if they're callable, but if they're not, you've made them for some period of time.
Mm-hmm.
You can't sell those very easily. You could pledge them with a federal home loan bank or a Federal Reserve Bank, and they would lend you some percentage value of those loans. It depends on how good they think the loans are, but you don't get 100%.
Right.
Okay. If you take your securities and they're in the held to maturity portfolio and you sell even one of them, under the rules, you have to mark the whole entire held to maturity portfolio to market, meaning it would create a huge loss for Silicon Valley Bank if they sold anything out of their held to maturity portfolios. They wouldn't want to do that. You don't want to create a loss. You can instead pledge them as collateral for a Federal Reserve loan or a Federal Home Loan Bank loan. But again, you don't get 100%. And there's limits to how much the Home Loan Bank will lend you, depending on your equity capital. And the San Francisco Fed obviously had a limit too. So if everybody's pulling out their money, because
why was everyone starting to pull out their money?
When they saw the financial statements, they could tell that the capital the bank said it had, it really didn't have if it marked its assets to a true market value. Okay. That's the first part. And the second part was they saw that its liquidity position wasn't very strong. And so rumors flow that, hey, it doesn't look very good. You got a lot of money in there, get it out. This is how bank runs start. So even though they got apparently a clean financial statement by KPMG at the end of their statement, their financials were not really rock solid.
Right.
In fact, if you mark their loan portfolio and their held to maturity portfolio to market and looked at a sort of true capitals, they were pretty close to bankrupt. Okay, even though they could report positive capital.
That's interesting. And is there any blame then for the Fed for raising interest rates at such a quick rate? It is. I mean, they said they were going to do it. So, and this gets into a broader debate.
The place to start is with the financial regulators, the banking regulators, the Federal Reserve as a regulator.
Mm-hmm.
They're supposed to be watching all these things. They go in the bank all the time. Now, in a bank this size, typically there's an on-site supervision staff from the regulator. The FDIC has backup regulatory authority. They all get the same financial statements. They knew last fall this bank had a big portfolio that was held to maturity and underwater, and they knew the interest rates were going to rise. It should have been on their watch list. It should have had what they call MOUs, memos of understanding, where the regulators tell them, hey, you're engaged in an unsafe and sound banking practice. You got to change this. You got to fix this. Board of directors have to sign off on it. This is typically the way bank examination process works. But they apparently weren't under any of these things. They weren't downgraded. They weren't on the FDIC problem bank list.
So is that where we should be looking in Congress? Is that where our Financial Services Committee should be looking and bringing those kind of regulators up to Congress and asking them why they didn't do this?
Yeah, why'd you miss this? Yeah, why weren't you watching this? I mean, I got a piece coming out this afternoon in the Hill where I go through the details on this. For example, worked in the FDIC for 10 years. One of the things I was in charge of was the economist that built and maintained the early warning models that flag problem banks. Okay, so we get financial statements every quarter. You feed them into an econometric model. There's historical patterns and trends that show you which banks might get in trouble. And in the FDIC's early warning model report, it said, what are some of the major flags that indicate you might have a problem bank? Growth funded by hot money, uninsured deposits, growth from a new business activity, that would be cryptocurrency in the case of Signature Bank, cryptocurrency relations. It would be SPAC money flowing in the case of SPV. And these are things that should have triggered, they should have been on the watch list for these guys. I mean, if they weren't on the official watch list, the problem bank list, they should have at least been flagged internally for special examinations and these people should have been looking at these banks.
Is the issue with Signature Bank? So this is a New York bank that also recently failed. Are we seeing a contagion? Should we be worried about other banks failing, or are these just both perfect storm kind of situations?
They're not. They're failures of bank management and failures of supervision. I mean, is it a perfect storm if it's been forecast for a year that interest rates are going to go up?
So they're both related to interest. Interest rates harm the banks in this situation, but bad management.
Bank, well, Signature Bank not as much, except interest rates are a factor. So, you have a bank account, okay? You got one. It's probably insured. It's probably not over 250,000. So let's just say you got a little extra money there, 20,000. They paid you 20 basis points, keeping your money in the bank. The money market mutual funds are paying 4.5. Aren't you going to take some of that extra money you don't need in your checking account and put it in the money market account? I mean, so rising interest rates are going to drain deposits out of the banking system. It's inevitable, unless banks step up and pay rates equivalent to what you can earn in a short-term treasury bill or money market account, and they're not doing it. I mean, in general, banks have excess deposits. They're slow to adjust them. So money is going to come out. Now, that's different than a run. That's a controlled sort of money leaving the bank. But everybody should have been prepared for depositors exiting the banking system and going where they can actually make a better short-term return in a safe instrument. That's
not something I thought about, but I guess because I don't have that much money in my bank account, and so I don't think about these things.
Well, someday maybe.
Well, someday. Well, and also, I mean, just a random question about just your general financial advice to people is so do people with a lot of money, do they generally split up accounts into 250K increments in order to ensure that their stuff is insured? How does
there's
a whole
service. There's a whole service that was actually created by a former controller of the currency at a firm that did this and created it. And it's a product that's called CDARS. And if you have a whole lot of money, you can use this firm, and it splits it up into accounts that are all insured at different banks under the 250 limit. And they have all the rules in place to ensure that you have insurance limit and you own the account. So yes.
Here's another, just purely your opinion. I mean, is that limit something that should be changed? It seems arbitrary. Why is the limit the way it is? And then we have this obvious problem where you have some small businesses that bank with Silicon Valley Bank who have done nothing wrong, right? They just deposit their money in a bank. They thought that was safe. Maybe it's $1 million, maybe it's $3 million. I don't care. That's still a small business. What do we? How do we help them? And currently, what is was the Fed talking about in order to? I know there is a plan to, I think, ensure that.
I mean,
I asked you a lot of questions in like 1 second, so I apologize for that.
Deposit insurance limit was fixed at $100,000 for a really long time. It went up to, first it became unlimited in the 2008 financial crisis because they wanted to protect all transaction accounts. Okay, transaction accounts you think of as business accounts, because the accounts, checking accounts that businesses have to make payroll, pay their bills. And as you say, you don't have to be a very big business before you have to have a balance of $250,000 just to, make payroll.
Just to operate, yeah.
Yeah, just to operate. And so back in the financial crisis, they're afraid of all these things running in 2008. So there was a blanket guarantee on all transaction account deposits for a long time. Okay. When Dodd-Frank Act went through, they raised the limit to 250K. Actually, I think they temporarily first raised the limit to 250K, and then they blanket guaranteed everything in 2008 financial crisis. Memory serves. Dodd-Frank came around. They made the $250,000 limit permanent. We've had a lot of inflation since 2011 when they did that. So you could argue that you should adjust it. But how much you insure then, investors don't monitor banks. Now, do they monitor banks at all? So there's an interesting op-ed in yesterday's Wall Street Journal, and it's in today's. It's by Charlie Calmaris. And, he points to the fact that the way the Fed has changed how they do monetary policy since 2008 has totally destroyed banks' incentives to monitor each other. Okay. The federal funds market is the market where banks borrow reserves from one another. Okay. So if you have a reserve, if you have money in the Federal Reserve and you're a bank, you have reserve balances. If you need money, you can borrow reserves from another bank. It's called the federal funds market. Before 2008, that market was very vibrant. Banks borrowed and lent federal funds between them all the time. There were reserve requirements they had to meet, and if they needed reserves to meet reserve requirements, they borrowed from a bank that had excess reserves. Now, the federal funds market, borrowing and selling your reserves, your Federal Reserves, they're not guaranteed. They're not collateralized. So if you were a bank and I were a bank and I loaned you some of my reserve balances and you went bankrupt, the FDIC foreclosed on you, I would be out. I would be out whatever I lent you because my reserve balances are not collateral. It's an uncollateralized loan. Well, back then, when that was a very active market and banks borrowed and lent out their excess reserves, banks watched each other and they paid attention to the, how sound was the bank they were lending to. Well, once the Fed started paying interest on reserve balances in late 2008 and on and stuff like banks, the federal funds market is kaput. Okay, the only funds that are traded in the federal funds market are balances that Freddie and Fannie and the Home Loan Bank has at the Federal Reserve because they're not allowed to earn interest on their reserves. So what do they do with their reserve balances that they don't need at the Fed? They loan it out to banks who then can earn interest on the reserve. So they're arbitraging. Are you with me a little bit, or am I losing you? It's an arbitrage right now. But
yeah,
the only people lending it out are like basically Freddie and Fannie and
sure,
yeah. And so people aren't worried about them.
Don't worry about me. It's educational for the audience. If they can always hit the rewind button.
But if I don't get to you, or at least make you interested enough to say, hey, this is an interesting problem. Banks don't monitor each other anymore because they don't borrow and lend between themselves very much anymore, like they used to. It used to be a very active market, and they all paid attention to whether the bank down the street that might wanted to borrow from them was really solid and safe. And so now the only people that are watching are the regulators, the Fed, the FDIC, the OCC, and they're not always so quick to find the problems. I mean, if you got money at risk, you're a lot more, you got a lot of money at risk. You're a lot more sensitive to the condition of the people you're lending it to.
Well, I mean, I think one basic question people have is, like, are we at risk of falling right back into that 2008 financial crisis? Now, my intuition says no. There's a lot of structural differences between now and then, right?
Yeah, and we don't have the basic rot in the system in the loan portfolio that we did back then. There was a lot of subprime mortgages that were very low quality. They were securitized and then re-securitized, and so there was a lot of rotten loans and a lot of rotten asset-backed securities that banks owned back then, and also broker dealers. And nobody really knew how good their counterparty was, so they didn't want to lend to them. So markets froze up because there were a lot of assets out there that were just of questionable quality. We don't have that problem right now, I don't think.
So, and the other question people have is, all right, are my tax dollars going to be used to bail out Wall Street again? Okay, now let's not get into how maybe overly simplistic that talking point was, no matter when you were using it. But in this case, on Sunday evening, financial regulators announced that they were taking steps to shore up the financial system. That included issuing what's called systemic risk designation for Silicon Valley Bank and Signature Bank, creating a bank term funding program, which is a backstop to prevent an additional crises. So maybe unpack what that means, and does that put taxpayer money at risk?
The first thing is the blanket guarantee for deposits in Silicon Valley Bank and Signature Bank. Normally, both of those banks had a huge percentage of their deposits that were over the $250,000 limit, the FDIC insured limit. I think Signature Bank had like 95% of its deposits were uninsured because they were beyond the limit, and SVB Bank was pretty close to that. I think it was in the 80s. I don't remember the number right off the top of my head. It was a lot. Okay, so most of their depositors would have at first got $250 back, $250,000 back right away, access to $250,000. The FDIC did take over the bank. It would have marketed the bank. It tried to already, and it didn't find a buyer yet. Then if it didn't find a buyer, it would run the bank, and it would sell off the bank's assets. This is the case for both banks. It would estimate what it thought the assets were worth, and for accounts that were over $250,000, it would give you access to some of that money based on how much they thought they could recover from the assets. Mm-hmm. And for the rest of it you had in the bank, you'd get a certificate against a receivership, which meant if they ever did sell it and make more money, you'd get paid off. Okay, but it would lock up your funds for a long time. You know, it takes years for receiverships to settle out if they go like that. Okay, so by blanket guarantee, nobody goes through that. They get access to all their money. Okay, now to do the blanket guarantee, the FDIC and the Fed and the Treasury had to agree to a systemic risk exception. Okay, you probably read that where they had to vote on it. It's in the Dodd-Frank Act to do this, I think, and it was in the FDIC Act before that. So they had to vote that these banks were systemically important. Now, there is a question here about whether these banks were on their own systemically important. You know, maybe Silicon Valley Bank, probably not Signature Bank. There wouldn't have been massive fallouts. There weren't a whole lot of other banks entangled. I guess the argument that you would make is the contagion to other banks. There's a bunch of other banks in the system that were experiencing, you know, their stocks were being sold off. There was risk that they were going to start to run, a bunch of regional banks. And so maybe that's the reason for the systemic risk. Now, there is a question I have about why they did that. Maybe you know, maybe you're in on the phone call. I don't know. Under the Dodd-Frank Act, when you have a systemic bank, what you're supposed to do is take over the bank holding company. SVB Capital is the SVB Bank's holding company. You're supposed to put the holding company under FDIC control, wipe out the holding company's equity and debt, and keep the bank open and operating. Use the assets of the holding company to fund the bank. Mm-hmm. They didn't do that. Okay, that's orderly liquidation authority under Dodd-Frank. It's the single point of entry. The FDIC is about that. I would want to know from Marty Gruenberg why they didn't do that. There is a holding company. Its stock is still traded. It's got assets. They didn't wipe out the holding company shareholders. That's what they're supposed to do in an orderly liquidation. Are you following me?
No, I mean I am, but I want to ask the simple question, especially for businesses listening who are banking with SVB and are worried right now. Are they going to get access to their deposits in the full amounts?
Well, yes. Under what they decided to do, they're going to get access to their deposits, their full amounts. If the FDIC and the Fed had agreed and they did orderly liquidation authority where they took over the holding company, mm-hmm. then they probably, and the holding company haven't had enough assets to plug any capital loss position in the bank, then they would have been whole too. It's just that holding company investors would have lost money. They would have lost, equity holders and debt holders would have lost, and they would have paid for it. Not right now, with the blanket guarantee, the FDIC deposit insurance fund is going to pay for it, which all the banks contribute to if there are any losses. And to the extent that banks pay FDIC deposit insurance premiums, they don't pay their customers higher. They take that out of the interest rate they pay their customers. So in essence, customers are paying for deposit insurance indirectly through the levy on banks. And so customers, if they're taxpayers, that's taxpayer cost.
So I just think from an ethical perspective, if your average voter says, would probably agree more or less with the following statement. So that we know the following facts: that this bank was mismanaged. Regulators also had a hand in screwing it up. Maybe the Fed increased interest rates too fast, but that doesn't really excuse the mismanagement of the bank for not anticipating that. So, but
the regulators from pointing it out that they needed to do something a lot sooner.
Right. But essentially you've got three categories of people. You've got the executives and the people who actually manage the bank. So the mismanagement happens there. Then you've got the shareholders that, invest in the bank. It's commonly traded stock, as you noted. Then you've got depositors who just use the bank, like they deposit money. And the question is, who ethically should be bailed out? I mean, my assumption would be, look, I think you should protect the depositors. And everybody else is, I think, out on their own. Is that sort of is the policy that the FDIC is instituted? Does it follow along that ethical framework, or are shareholders also getting bailed out? And is the bank CEO going to get a big bonus the way they used to in 2008?
Okay. SVB Bank has outstanding shares. Okay, so they have shareholders, but those shares are mostly owned by the holding company that owns the bank. So SVB Bank is owned primarily by SVB Capital, which is a holding company. It's a bank holding company. Okay. And that bank holding company owns other stuff. And the bank holding company has shareholders. So when you wipe out the shareholders of the bank, it costs the shareholders of the holding company, but it also costs the FDIC deposit insurance fund, because the deposit insurance fund is going to have to cover the hole in the bank. Whatever money has to come up to pay those depositors and make it available. But the holding company that owns the bank, their shareholders take a loss on the shares they owned in the bank, but they go on with their life. They don't lose everything. The management of the holding company, who actually runs the bank, tells them how to run it. They don't lose their shirt. They don't all get lost. So they are being shielded in some sense by what the FDIC is doing. Okay. Since Dodd-Frank, if it's a systemically important bank, this is a systemic risk exception, they're supposed to take the holding company over and get rid of their equity and their debt, make the holding company take the loss, and then take the assets that are left in the holding company and use it to fund the bank, to make the bank whole. So the FDIC deposit insurance fund doesn't have to. That's the way it's supposed to work under order liquidation authority. They didn't do that. I don't know why they didn't do it.
And I don't either. But it sounds like that's a question we need to ask. And one last question I want to ask you before we wrap up too is, taking a step back then, I mean, what reforms need to be made? The Dodd-Frank was passed in 2010, post-financial crisis. There's plenty of criticisms around. I mean, has it been an overall benefit? There's some would suggest, I mean, I think I think some would point out evidence to suggest that it's been very, very costly and detrimental to low to medium-sized banks. Yeah. Has it been overall good for our system, and if it's not even being followed to the letter of the law, as you've just noted here, then what good is it, and what reforms need to be made?
I mean, that's a huge question.
It is
incredibly complicated, and
yeah, and I don't want you to give you a complicated answer either. I'm just, maybe a couple. I know. Well, this is an extremely complicated subject.
I'm a banking geek.
Yeah, no, it's good. That's why I brought you on. I'm not a banking geek. Usually, I can geek out on certain topics. This is not one of them. So yeah, I'm just trying to ask super simple questions.
There's a couple things. I think your question about is the $250,000 limit still the right number? I think that's a good question to have discussions about. Okay. And the fact that small businesses, it doesn't take much. A business doesn't have to be really huge until that limit becomes important. Do we need to make any adjustments from that? Okay, that's a good question. I think there are other aspects of Dodd-Frank which have been perverse. Okay, so one of the rules that's been put in place for the largest banks, and the large bank rules also filtered down to the smaller banks, is things like the liquidity coverage ratio. So, not to be too geeky, the liquidity coverage ratio says something like this. You're supposed to have some kind of stress test model. There is one, there's a regulatory model that says in a crisis how much of your money will run. Depositors, broker deposits, commercial paper, how much will it run, okay, in 30 days? You're supposed to have what they call HQLA, high quality liquid assets. The bank has to have high quality liquid assets equal to the amount that runs, so they can liquidate them should they meet a liquidity crunch. Okay. Now those high quality liquid assets are treasury bills and notes, mortgage-backed securities, all the stuff these banks owned. Okay, because the rules say you have to own a bunch of this stuff to meet the liquidity coverage ratio.
Right.
But they didn't anticipate a banks owning a bunch of this stuff and interest rates going up on them. They forgot about interest rate risk. Banks bought a bunch of this stuff to meet things like liquidity coverage ratios, and they wanted some yield on it. So they went out in the yield curve a little bit, and now they're underwater on some of this stuff. So there's lots of perverse things in the rules that people didn't think about back then when they invented this world of regulation. And there's stuff that probably should be revisited, but I can't tell you everything in the Dodd-Frank Act that that ought to be changed.
That should be a book.
Those are two things I can think of.
Yeah, no, I appreciate it, and I appreciate your insight. I think unpacking some of the complications of this, that's why I want to have you on, and I appreciate you making the time for us.
Oh, I really appreciate talking to you, and happy to come back on. I hope I haven't geeked you out too much.
No, it's good. No, I'd love to come back on. Maybe next time we actually just take a step back and do some monetary policy, banking 101. Because I think a lot, and I've done quite a few episodes on this, just on the Fed and on trying
There's
to
a lot of interesting stuff going on there to talk about,
and crypto, and I mean how that's affecting the future of the banking industry. I think it's monetary policy used to be a little simpler thing when you just stuffed your money in your mattress, and it's just quite different now, and it is a lot different. It's a little different. So no, we need smart people to unpack it for us. So Paul Kupiec, everybody, thanks for being on. Thanks for helping unpack that, and we'll see you again soon, I hope.
Thanks, Congressman, and keep up the good work.
Appreciate it.